As you correctly observed, we had a very successful AGM, and the shareholders were quite pleased with our 2018 numbers, and they gave approval to the dividend proposed by directors. So with that done and dusted, we are looking forward to 2019. And again, 2019 slow start, and even as we saw a drop across the industry players with respect to loan book, we had to begin to look at other sources of revenue. And that's where the non-interest income came in. We saw it coming last year. We made investments in our digital banking platforms, and they're beginning to yield results. If you look at the 2018 numbers, about 25% of non-interest income came from electronic banking business. And that tells you that we are quite strong and big in that area. And increasingly, you're going to see more of that. And how do you explain that? Look at the ATMs. We've got nearly 3,000 ATMs. And so fees are going to come from there because of large usage. And we are spread all over the Federation. So you will expect that. And then look at the mobile banking, the USSD. So we are number one by a long shot with respect to star 894, which is USSD banking. And this is something that was not there for us 2 years ago. So we made significant investments on that platform. And so increasingly, even as we wait for restarting of lending, and as the economy restarts or is reflected, you're going to see more coming through from non-interest income. So for us, we are anticipating that for full year 2019, about 33% of the non-interest income will come from electronic banking platforms or channels.
Now, looking at your loan book, we saw that the non-performing loans moderated by about some 42.2% year on year. Speak to us on the core strategies that drove this performance.
So first of all, let's agree. Last year, we had muted growth on the loan book. Okay, and then that also means that because you report net in terms of balance sheet reporting, you have to back out the NPLs. So you had a drop, further drop. But going into 2019, we've guided the market to 5% growth on loan book on the back of expected improvement in macro, essentially. So we're going to see improvement around that area. What sectors are we looking at? Manufacturing will top, clearly. General commerce. And then we're going to see a whole lot happening around retail loan book because we've got huge retail base. And we have products that we have launched in 2018 that will begin to yield earnings for us into 2019. Agric will also be a critical sector for us. We are looking at very many government policies that are impacting positively that sector. So our view is looking at all those sectors that government is intervening in, where the operating environments have improved, then we can leverage that, and also our huge customer base across the entire network, from the corporate banking to commercial and to retail. We've got a huge and deep pipeline. And so that's what gives us confidence that we can grow at 5% for 2019 financial year.
Now, talking about sectors that the bank would focus on in terms of loan performance and areas of interest by the CBN and the government going forward, I recall that during the AGM just finished, one of your shareholders did get up to express a point of order, saying that it did appear from the books that the bank was not showing as much interest as it did in agriculture compared to the year before this one. Speak to me on, just give more clarity to that situation. Was the shareholder mistaken, or will the bank be revisiting its strategies towards helping the agri sector of the economy going forward?
But look at our track record. Historically, we've always been one of the major supporters of agriculture. And in the last 3 years, we've held yearly fairs, Agric Expo, here in Lagos. And we normally have in attendance hundreds of exhibitors across from across the country. And so we have a deep interest in agriculture. Also, based on our spread, we've got the major agric companies that are working with us. Without mentioning names, the value chain we are impacting significantly. Perhaps the shareholder will need to engage further, and showcase what we are doing. I think that's the takeaway for me, that even as we support businesses, we need to actually be in the space, in the public domain, to showcase what we are doing to support agriculture. But clearly for us, agriculture is a major sector we need to support. And we've got a very strong pedigree. We've got structures that speak to our commitment to agriculture.
The IFRS 9 is reported largely to have impacted the capital basis of banks across the sector. Speak to me on how First Bank is responding to this regulation, and going forward, how the bank will be responding.
So, first up, it was a one-off charge which all banks had to take, because Central Bank came up with the policy that effective 2018 we should all be IFRS 9 compliant. So the first day of 2018 you had to restate your 2017 numbers, and of course that also allowed you to take charge on your equity instead of processing it through the P&L. What that means for us, effective, that we took advantage of that window to clear all the legacy issues that we've always talked about. And that is why you saw a little spike in the MPL. But that is only to the extent that you are providing, okay? So we have huge coverage ratio right now, 82%, trending towards 100. The next step will be for us to begin aggressive recovery, which will happen in 2019. And then when you recover, of course, it goes back straight into equity. So momentarily, there's a drop in the equity base. But clearly, as you recover and as you restructure and write back, it will impact shareholders positively. So for us, we are saying to the public that we have sufficiently dealt with the legacy issues. And again, for emphasis, if you check the MPL on the legacy loan book, which means loans given out in the last 2 years, the MPL ratio has maintained 0.3%. That speaks to how robust, our risk architecture is. From the people, technology, and process perspective, we believe we have first-class or world-class, platforms that will mitigate against any loan loss formation going forward.
Finally, your thoughts on the declining yield environments generally and your outlook for the bank's results going forward.
Well, for us, we are looking at expanding the loan book. So it goes beyond investment in government securities. I think overall, you earn more when you lend to the real sector. If you think about the trickle-down effect, beyond the interest income, you're also earning fees, you're earning charges, you are doing LCs. So we are looking forward really to the real sector borrowing from us. What we put in government securities will be the liquidity that are not readily, we're not ready to deploy. But once we see very solid obligors without compromising quality, because for us, the key thing to managing the MPL is quality at entry. You evaluate the risk, so we moderated our risk appetite. We are very clear on the sectors we want to lend to, but more importantly, the obligors must be first grade. And that way, you keep your MPLs at very low levels. If you look at our loan book or the loan distribution, you will see we are fairly tight, as it were, on oil and gas, where we are at about 42% of total loan book, but that's from a high of 50 plus 2 years ago. So we will be seeking to rebalance the portfolio, okay, and deal with the oil and gas accounts. And as we moderate the volume of loans in that sector, we can re-enter. Again, that is not to say we don't have quality obligors waiting on the doors, the corridor to take loans, but we're saying we need to do optimal portfolio balancing. And so for us, even looking at what is happening in the oil and gas space, where you've seen volatility in oil prices, we need to be able to moderate our appetite on oil and gas. But again, as we walk down the portfolio, there are good names in that space that will re-enter our book. And so we're not going to say no, but we're a lot more deliberate in picking the loans that we'll book in 2019.